Hi, wonderful community. Welcome to this week's video, and we have a special guest, Alysia Laird from Zebra Tailored Wealth. Some of you may be familiar with Alysia. Of course, as a Verve member, she is part of our support squad. So if you're a member, you can actually organise a chat with her with no cost, and she is a very experienced financial planner, and she's going to give us some tips and some actions to consider in the run-up to the end of financial year. So as always, we can't give personal advice specific to your situation, but of course, and what we do talk about is, you know, educational and generic in nature. But of course, I hope you walk away with some great ideas and really important, valuable actions to take in the next couple of weeks. So, Ali, tell me a bit about you. How come you are, you know, so passionate and care so much about what you do?
Yeah, hi Zoe, thank you. I have been a financial planner for about 20 years, but it's probably only in the last couple of years that I have started my business, Zebra Tailored Wealth. Started dealing with a lot of your members as well at Verve Super, which has been wonderful. And yes, 4.5 years ago, had my first child. 2.5 years ago, had another one. So I got 2 beautiful daughters now. Lots of life experience under my belt, and just really enjoy helping people, helping anybody that needs it if they're kind of uncertain about their finances or the path forward, and just giving people a bit of clarity where they need it.
Great. So what are, just before we go through the top tips, what are some of the areas where you help people? Like when should we go and see a financial planner, I suppose?
Yeah, look, never too early or it's never too late, really. Like I see people who are 60 something years old and have kind of managed to get through life not getting any help and realize that perhaps they need it now. But, you know, also see a lot of young 20-year-olds who are really just starting out on their journey, but keen to get a bit of clarity and, you know, even start to build up their wealth just from a very small base, which is awesome. Like, so they'll be putting themselves in really good stead for when they are 60 and then retiring or moving on to their next part of their journey.
Fantastic. So as we approach the end of the financial year, what are some of the things that we could be thinking about and to make, you know, some good financial decisions over the next couple of weeks?
Yeah, so there's a few kind of easy little tips that people could be thinking about if they felt they had a little bit of spare money to kind of think about their future selves and add to their super funds in a way that perhaps will give them some sort of tax break or give them extra money from the government and things like that. So we've got kind of 5 top tips here. And the first one, which is a really nice, easy one, is called the government co-contribution. So if people feel like they have $1,000, up to $1,000 that they could spare to pop into their super, depending on their income, if they're earning kind of less than $53,500 per annum, then the government will potentially give them $500, so a maximum of $500. So they pop in $1,000, and when they do their tax return and say to the government, hey, I popped in $1,000 as a personal contribution, then the government gives them $500. So, you know, if we talk about returns each year and say, yay, we got a 7% return on our super fund, well, this is essentially a 50% return on your money before you've even started to earn and have it grow and stuff like that. So nice, easy money if you feel like you have $1,000 spare to add. Okay. So that'd be top tip number 1.
Okay.
The next one would probably be deductible contributions. So that first contribution I've talked about is just a personal contribution, and it's just from your bank account. So it's kind of after tax money. You pop it into super. You don't get taxed on the way in or the way out. and you potentially get that government benefit. This next one is more like salary sacrifice, or a contribution that you make to super, and you pay 15% tax on the way in, but the government actually gives you a personal tax deduction. So some people's marginal tax rates might be 32.5, some people might be paying 40-something% tax. And essentially by adding this type of contribution to super and claiming it as a tax deduction, they're only paying 15% instead of 30, 40. So it's just like salary sacrifice. And in the past, somebody that was employed had to do it regularly through their employer. So we wouldn't be able to talk about it at this point in time because it would be too late. But they actually changed the rules a few years ago, and anybody can choose to make a contribution to their super and then claim it as a tax deduction. And it doesn't matter whether they're employed, not employed, have their own business. It's available to everybody. There are limits, so maximum $25,000 that you can add, and that includes what your employer pays into your super. So we know employers are paying 9.5% of our salary. That plus whatever you add as a deductible contribution, the maximum benefit you can get for that is $25,000. But yeah, pretty nice way to save on that tax bill and get a nice personal return when you're doing your tax at the end of the year.
And also people can have a chat, if you do have an accountant as well, have a chat to your accountant and see where you're at and as well.
Absolutely. Yeah, great time to be doing a little bit of kind of strategy planning with your accountant. Yep. So that's top tip number 2. Number 3 is more about people that have spouses or partners. And there's a couple of things that people can do there. One that I find people don't use that often, but it's quite good for kind of equalising super balances. So if we've got mums who are maybe not working or working part-time and therefore aren't building up their super as much as they otherwise would have, and their partner is still at work full-time and adding to theirs, well, there's actually an option for the partner to put in money, like we talked about in point number 2, like deductible super contributions, and then split it across to the spouse once it's in. So it's kind of, it's your partner's $25,000 cap that we're using. It's your partner that's getting the tax deduction. But then that 85% of whatever they've added, because we've paid that 15% tax, 85% of whatever they've added can actually just be split across to the spouse. It can only happen once a year, but it's just a really nice way for those years where maybe women aren't earning as much or aren't earning because they're on maternity leave or something, to equalise those balances without having to just physically go and put $25,000 cash into your super.
On that note, I've also had some really powerful conversations with women over time when they brought that up with their spouse, and how it's opened up other money conversations and because, you know, essentially, yeah, you're talking about, as you say, that equalising, you know, and really valuing that work you're also doing at home. And I think that then that even conversation in itself, not only, you know, is there multiple financial benefits of doing that, but also there's a ripple effect of having those conversations as well.
Yeah, that's awesome. Yep, and on the similar lines, so there's the spouse splitting, and there's also something called a spouse contribution. So same kind of thing, maybe in those years where the women aren't earning as much or something, because here you have to be earning less than $40,000 a year. But essentially the spouse or the partner can put $3,000 into our super fund, like into their partner's super fund. And that earning spouse will essentially get a $540 tax offset, tax rebate. So kind of cash back at tax time, which everybody loves. Yeah. And they've also, you know, we've also kind of built up that super fund of the person who's not working as much in those years by $3,000 each year. So,
and
yeah.
As you said earlier as well, it's not just the extra $500 here or $3,000 here, but that compounded year on year, you know, for the next 20, 30, 40 years, that's what really, when you're making these sort of seemingly small decisions each year, can have make a huge difference to your level of comfort in retirement, right?
Yeah, that's right. Serious snowball effect. You know, if people are managing to do this in their 20s and 30s and then getting, you know, it's literally just sitting there earning for the next 30 years, it's pretty amazing the value it ends up being.
Great. So we have talked about spouse contributions, talked about government co-contribution, talked about personal contributions. Anything else you have for us?
A little one on kind of insurances and protection. So income protection premiums. So we get income protection, which essentially means that if something happens to us by way of illness or injury, that the insurance company will continue to pay us some of our wage when our employer can't really continue to do that if we're not able to turn up to work every day. And those premiums are tax deductible. Some of my clients a lot of people like to pay things monthly, just because it works for them for budgeting reasons. But some people in June each year could decide to essentially prepay a year's worth of income protection premium. So kind of pay that annually in June rather than monthly. And it just means you're getting that benefit a little bit sooner, because all of a sudden you do your tax in August, September, or whenever you like to do it. And you're getting that money back already. So it's more money in your pocket to use for other fun things. So yeah, that's just a little nice, easy, quick one if you're paying for income protection premiums personally. It's not for income protection premiums in super, just the ones that are paid for outside super.
And that brings up a good point as well, that, you know, the end of financial year or the start of the new financial year is a great time to check in on your general financial health, right? And have a just review your insurances, review your, you know, you might not have to change anything, but just double check. Am I happy with my insurances? My will's up to date. My, you know, my savings are going in the right, you know, pots, and
yeah. You just kind of tick it all off and then kind of be like, right, I'm done with that for a little while. And
yeah, especially when and maybe this is for another topic for another day, in the things to do in the new financial year, but when you're already pulling all your pieces together for the for tax time, it's a great opportunity to check in, right?
Yep, exactly.
So any other parting words, Ali?
Yeah, maybe the final one. I know a lot of our Verve members are kind of wanting to build up their money to buy their first home. And a lot of people probably don't necessarily know about this one, but there is something called the First Home Super Saver Scheme. So there was always things like the First Homeowners Grant that everybody knew about. Yeah, but there is something called the First Home Super Saver Scheme. So people can put up to $15,000 a year into their super. $30,000 a year in total. That's kind of the maximum we're allowed to do. They get the tax deduction. So it's like in point 2, that deductible contribution if we want, where we only pay 15% tax on the way into super and we claim a personal tax deduction. And then they can grab that money back when they're ready to buy their first home. So they can use that. You know, they're probably trying to build up their money in cash. Maybe investments, depends on the time frame they have when they want to buy their house. But, you know, that'll be a nice 30,000 or whatever it's managed to grow to use to boost the deposit when you're buying your first home.
Yeah, great tip. And we get asked about that quite often, and a lot of people aren't aware of it. So that's great.
So they're the top 5 tips.
Great. Thank you so much. And for anyone with any questions, please pop them in the comments below and we'll continue the conversation. We'll also have a supporting blog with a few different links to point you in the right direction if you'd like further detail on any of these action items. So, yep. Have a good time putting some things into place as we run up to the end of financial year, and we'll see you next week. Thanks, Ali.
Bye.